Hi and welcome to this week's Property Insider video. In my chat with Dr. Andrew Wilson today, we discuss what's happened to our property markets in the first quarter of 2021 as Dr. Wilson gives you his asking price index and which property markets have outperformed others. We're also going to discuss ANZ Bank's forecast of 17% property price growth around Australia. Is it really feasible? And are APRA going to interfere and slow down our property markets? There's lots more property news as well, so if you want to keep up to date with our weekly Property Insider videos, please subscribe to this channel and click the little bell icon to be kept up to date each time we bring a new show out. It's been a busy week for property news, but despite all the good news, the pessimists are still out there throwing out headlines like house prices go boom, but it's a bust around the corner. Or as New Zealand scraps negative gearing, Australia's closer to its own cooling measures. Now, while it's clearly important to look at all possibilities, I think it's better to focus on the positives rather than the negatives, as optimists always do better than the pessimists in this world. And boy, is there a lot of good news around at the moment, including the continuing surge in property values around Australia, the reported forecasts of significant property price growth in the year ahead, continuing evidence of our strong economic recovery, which seems to surprise most economists, and a report from the Australian Bureau of Statistics showing that not only did household wealth hit a record high at the end of 2020, but the lift in wealth in the last quarter was the biggest record in 11 years. These are some of the topics I'm looking forward to discussing today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yes, good morning, Michael, and we're all looking forward to the Easter break coming up. And I guess the housing market particularly is looking to have a well-earned rest and breather over the next week.
Well, it's been chugging along very nicely. It's in fact in the middle of a broad-based boom and property values continue to rise around Australia. So I'm interested in hearing your thoughts on where the Australian property market is at the end of the first quarter. But before we get into that, let's have a look at how the auction markets performed, because it was a pretty astounding result for the Super Saturday just gone.
Yeah, well, I don't call it Super Saturday for nothing, Michael, I suppose. And this was one out of the box, this Super Saturday. Of course, Super Saturday refers to the weekend before the Easter break. We always get, I guess, what you call a front-end loading of auction numbers over that weekend every year. Typically, it's the biggest or one of the biggest weekends for auctions in our capital city markets. And we were having, I guess, very strong or high expectations that this would be perhaps a record result for some of the capital cities in terms of auctions. And we weren't disappointed, Michael. Sydney broke the all-time record for the number of auctions conducted on a Saturday, over 1,200 auctions conducted. That was higher than the previous record set back in 2017. Sydney also broke the record for the number of properties sold under the hammer on a single day. Also, the value of properties sold under the hammer on a single day in Sydney. So that was the trifecta of records in the Sydney market. And guess what? Another 90% clearance rate, Michael. Can you believe that we'd ever see these sort of numbers? 4 clearance rates out of 5 weekends above 90% in that Sydney market. And obviously, which we'll speak about shortly, it's translating into strong prices growth across the board. And all regions in Sydney are experiencing this boom time level of activity. So Super Saturday in Sydney. Melbourne not far behind, although the clearance rate in Melbourne wasn't in the 90s. And is that becoming the benchmark? I don't know, Michael. But Melbourne recorded its highest clearance rate for the year so far, which was obviously a good result for sellers there. Its numbers were just below, its auction numbers just below the previous Super Saturday, pre-Easter Super Saturday record set back in 2017. And I mean only just below by a couple. And it was one of the highest days ever in Melbourne for auction activity anyway. And to get an 83% clearance rate was a great result considering how many auctions there. But Melbourne did break the record for the number of properties sold under the hammer in a single auction day, and also record level value of properties sold at auction. Other capital cities were also very strong, Michael. Brisbane numbers have been down a little bit compared to last year and other pre-Easter weekends. And I think that's what's really starting to activate those clearance rates. We've never seen clearance rates as high as this in Brisbane, as we do discuss on a weekly basis. I think one of the reasons is there's just a lack of stock up there, and people are really jumping on anything that's for sale there. But Canberra and Adelaide, again, high numbers of properties there and high clearance rate. So it was a Super Saturday across the board. And as I said in the preview, Michael, I think markets are looking for a well-earned rest. But this is typically the punctuation point of the first part of the autumn selling season, Michael. We do build up to the Easter Super Saturday, and then we have our Easter break, and the market then starts to re-energise itself over the second part of autumn, and then our winter market starts on Queen's birthday weekend. But certainly it's been an unprecedented activity in our auction markets over the first part of the autumn selling season, and certainly likely to continue through to the midwinter period. So I'm exhausted, Michael. I think those poor buyers out there are pulling their hair out because they're missing out. And I think that's the issue with buyers at the moment. The two main emotions are disappointment and having to reduce their expectations in terms of the properties that they're looking for.
Yes, the markets are really moving in front of their eyes. And that's why I like hearing what's happening with the auction clearance results, because it's an in-time indication of what's happening in the markets compared to the sale results that you get sometimes a couple of months later. Another indicator I like looking at, and I know that you report, is asking prices,
Yes.
which are very accurate when you look 3-4 months down the track on what the other median price and hedonic price results are showing. So what are you seeing in asking prices over the first quarter of this year, Andrew?
Well, look, no surprise, Michael, as you suggest, or as you stated, I track daily asking prices. So there is some volatility of that, of course. But when we compare end of month to end of month, we do see the same sort of pattern of growth emerging as when we get the later data sets that reflect on prices, which of course are sale prices, which are more of a backward looking measure of activity. But if we look at, no surprise, the Sydney market asking prices in Sydney, which are now well above $1.2 million, the median asking price there. And of course, that's compositionally adjusted, that particular total. But we saw that over the month, Sydney asking prices, that's the month of March, increased by 2% over the month. Over the year so far, Sydney's median asking prices are up by nearly 7%. So that reflects, of course, those very strong clearance rates. We shouldn't be surprised at what will be, Michael, near record price growth, I think, when it's all said and done over the March quarter. We have to go back to the late 80s to see this sort of growth level. And that was just an extraordinary market, as you...
I remember those days well.
Yes, they were crazy days in Sydney, but we're certainly getting up towards those levels now. Other markets didn't grow quite as strongly. Melbourne up just 0.1% over the month. And of course, there were some early shutdown issues in Melbourne, we've got to remember, a month or so ago. And up over the year, just 1.5%. Brisbane up over the year so far is up around 6%, Michael. So that's also showing strong results there in Brisbane. And the other big mover is Perth, where we're seeing over the year Perth house prices are up by 6%. So annual prices growth in Brisbane and Perth is quite strong. But so far, with this year so far, Sydney is the clear leader with prices growth matching that in Perth and Brisbane that they've recorded over the whole year. So we await those official results, or shall we call them official results, those other results for that Sydney market. But, you know, hang on to your hat. There's going to be a big number coming out of Sydney for sale prices because we're seeing big rises in asking prices.
Well, the ANZ Bank agrees with you. They've done a complete about face, and their most recent house forecast suggests around 17% overall in Australia. Now, we know that there are different markets going to perform differently, and they believe 17% price growth in 2021, slowing down to 6% in 2022. And their senior economist expects APRA to introduce macroprudential controls to slow down the price growth in 2022. So I'd like to ask you two questions on this, Andrew. First of all, what's your thoughts on the bank's forecasts? But secondly, what are your thoughts on APRA's intervention, particularly in line that this week Wayne Byers commented to Parliament saying that it wasn't APRA's responsibility to look after soaring house prices. And by the way, he didn't see activity right now would compel any sort of intervention.
Well, I'm dizzy, Michael. I don't know if you're dizzy, but when looking at ANZ forecasts, I can't figure out, is that a plus sign or a minus sign in front of their forecasts? It seems to go from minus 20 to plus 20 odd. year in, year out. I mean, they just don't have a great record, do they, in terms of forecasting? I think it's highly unlikely we're going to get 17% national price increases this year. I think Sydney and Melbourne markets may have an upside of 12%, maybe 15% in Sydney. I think that's highly unlikely. Certainly the year started off very strongly. But I do think that the March quarter will be the peak of the market in terms of prices growth. I think it will ease from here. We don't have lower interest rates or higher incomes to keep pushing prices up. As I've said constantly here, Michael, it is about catching up with where prices should be if it hadn't been for all that interference, APRA included, over the past 5 or 6 years. And once they reach those levels where they should have been, they'll start to ease, as I said, without higher incomes or lower interest rates. And as far as predicting APRA intervention, again, the banks keep getting this wrong. I'm not sure where they're getting their information from, but it certainly doesn't have any depth to the analytical process, in my opinion, because APRA have come out quite clearly, as they always were going to do, and said that they're not going to interfere in the marketplace. This isn't a market that's being fertilised by record levels of investors. In fact, we have record low levels of investors at the moment, which, in my opinion, is a result of that APRA intervention, which was highly questionable back in 2015-16 and then again in 2018-19. It's interesting, Michael, when we look at interest rates for investors versus owner-occupiers, back in 2015, the spread between the variable rate for investors and owner-occupiers was in favour of owner-occupiers by around about 0.2%. That is, that they had a discount versus investors of around about 0.2% in terms of their variable interest rate. It's now 0.7% difference between what an investor has to pay and what an owner-occupier pays. So that credit squeeze is certainly a significant reason why we have record low numbers of investors at the moment. And of course, there's just no justification for entering into the market by APRA to try to cool this perception of an overheated housing market. And they've come out quite rightly and said that they won't be doing that. As I said, the market will cool of its own lack of energy going forward, in my opinion. And it would be, again, a mistake by APRA to interfere in this process of an orderly market adjustment, as they did back in 2015, 16, and again 18, 19, to which I think we are still paying the price in terms of this outbreak in prices for that interference from APRA during that period, which just created a roadblock to orderly market adjustments. I think one of the big problems that I have quite seriously in regard to a lot of these headlines that we see, particularly from the financial press, in regard to perceived intervention from regulators, overshooting house prices, and, you know, the impacts of the end of JobKeeper. If you're making decisions based on what are clearly hysterical and erroneous perceptions of the markets and the economy, then you're going to make mistakes. I think that people have to be more circumspect about looking at rational information when they're making their decisions, particularly their investment decisions. Having said that, I saw that the Commonwealth Bank is now suggesting that there's a rush to market to lock in short-term interest rate packages, short-term mortgage packages. And I think that for what reason, I can't think, why would you be locking in a low rate now for 3 or 4 years, given the costs that are involved in changing your mortgage package and the likelihood that there's no way interest rates, and the Reserve Bank has conceded that there's no way interest rates are going to be higher over the next 3 years and likely beyond. So, but you can understand the bank's position. They're experiencing very low margins at the moment, and they're looking to, I guess, pursue different products to try to increase their profits. But it's all about investor beware. Make sure you're looking at rational information resources before you make any investment decision. And we know if you had have based your investment decisions over the last couple of years on some of the silly headlines that we've had, you'd certainly be tearing your hair out as well at the moment, given how high house prices will continue to rise in the foreseeable future.
Yes, interesting. If you had sold up a year ago, and it was around a year ago when all those doomsayers came out and predicted significant property price drops, where would you be today? Well, you wouldn't be in the position that a lot of Australians are, Andrew, because only recently the Australian Bureau of Statistics showed that despite many of us suffering during the pandemic and the recession, there was clearly a good time for some people, especially those who own property. According to the Australian Bureau of Statistics, Not only did household wealth hit record highs at the end of 2020, but the lift in wealth in that last quarter was the biggest lift on record. And it came from the fact that Australians were stashing their cash, they had more cash, the investments in their share markets and the superannuation went up. But a large part of it, Andrew, was related to the fact that Australians own property, their home, and a portion of Australians, around 2 million, own an investment property or two.
Yeah, well, that's right, Michael. It's all good news stories at the moment. At least we'll have the end of the doomsaying JobKeeper cracks the economy headline that we've had for the last 6 months. There's a lot of backtracking already that's occurred on that. Let's remember that unemployment rate was spectacular that we had over February, and it'll be interesting to see the March result, which we'll take into consideration at some level, in March and April, at some level, the end of JobKeeper. But Australians are getting on with the business of getting back to work. And it was interesting, as you mentioned last week, Michael, that so many of the jobs that were created over February were full-time jobs. So that's a great sign for the economy. It wasn't just part-time casual jobs that were temporary, I guess, in a sense. These were full-time jobs that were created. So onwards and upwards. But as we keep saying, Michael, there are still hard yards to go. We need to get an unemployment rate clearly with a 4 in front of it, not a 5. And that's going to take a hell of a lot of hard work going forward. That is before we ever can consider creating the prosperity and the incomes growth and the inflation that would be required to dampen down a heating up economy. And let's hope we do see that, in the next decade, because remember, it's a decade since we've had higher interest rates, and it might be at least another decade before that repeats itself again.
Well, we are coming up to Easter. I hope you have a great time with your family, and I'll try not to eat too many Easter
Too many eggs. That's right, Michael. Just relax.
You know my penchant for chocolate. Look
Yes.
forward to catching up with you next week when we'll be able to see what the results were for the end of the month, and look forward to hearing your thoughts for what's going to come ahead.
Thank you, Michael. Happy Easter.